The best spots on the markets are the ones where you cannot lose. Here's how I'm robbing the bank and getting away with it whether it works out or not. I have identified a highly interesting hedge spot, a statistical free roll if you want. This prospect is divided into two separate parts, the technical trade itself and its hedging advantages. Here's the in-depth reasoning behind this action. Let's start off with the technicals, but first and foremost, not financial advice, and please like, share and subscribe. You know the drill. Now, I have entered a short in Swedbank right here. It was at a 5.2 leverage and my stop loss is set at 154, as this would amount to a new local high, which would likely coincide with the index testing or taking out a new all-time high too. Now, I've taken this trade for 5 reasons. 1. It was again rejected by the strong horizontal resistance line. 2. The RSI has a difficult time pushing above the upper bearish blue line. 3. The stock was again rejected by the descending channel, this time by the new channel for whatever it's worth. 4. Swedbank is now trading right at the EMA 200 on the monthly. This is serious business and bad news to anyone who is hopeful on the recovery of the banking sector. And 5. It would constitute a proper hedge to any index correction. This last point is particularly relevant as Swedbank shows a lot of weakness. This means that the upside, if the index were to break above, is more limited than the downside and amounts exactly to the type of hedges you want to hold. And this is what we'll focus on in this episode. Upon retesting its all-time high, suppose the index would either get an immediate 10% breakout to the upside or a 10% breakout to the downside. Would these affect Swedbank's reaction equally much? No, they wouldn't. And here's why. For while the index is going strong with a big asterisk, Swedbank entered a bear market already in early 2019 and has ever since struggled to keep its technical nostrils above the water surface. And at the moment there is not much that indicates strength. For more on this, please watch the episode Banks, the King Must Die. And when a stock or equity is in a bear market cycle, good news tend to have less of a positive effect on the price, whereas bad news, however minor, can cause some serious damage. The same goes in reverse when a stock or equity is in a bull market, and the further into a bull or bear market cycle a stock is in, the more disproportionate any news become. You would, for example, need to present some exceedingly bad news to put a halt to any galloping stock that is in the midst of a parabolic run. Then the same goes in reverse. Ask any long-term fingerprint card stockholder how good news is being received by the market at the moment. Or since 4 years back for that matter. In that sense, if the index were to go up by 10%, Swedbank might only go up by 7 or 8. But if the index were to drop by 10%, especially if it were to happen fast, then Swedbank might suffer a 15% crash or so. This on its own makes Swedbank a highly interesting shorting candidate from a risk to reward perspective. And add to that a technically sour condition and you've got yourself a long-term winner. On the short side that is, which is why I've entered a new short at a 5.2 leverage just below the resistance level at 149.60. As mentioned in the beginning, my stop is set at 154, as this would likely indicate an index outbreak to new all-time highs. And my initial target is set at 139 for a 2.4 to 1 risk-reward ratio. However, upon an index correction, I'd expect it to go much lower than that, which naturally would expand the risk-to-reward ratio too. And to add to this already technically lucrative prospect, if the index were to go up, that would mean that my small and mid-cap long position would go up by a lot. And the sole reason for this is because small and mid-cap stocks tend to move exponentially to that of the index. And here's the funny thing, the thing that explains the title of this episode. This leverage short is technically a derivative that is issued by a bank, and we're using a bank to bet against another bank. If it goes our way, we're robbing the bank of its money whilst at the same time watching the entire industry burn for a moment. And I personally don't mind that, as the banking sector repeatedly abuses its too big to fail status to take on stupid risks and get bailed out by tax money every time they mess up. It is an entire industry that has become permeated by corruption and market manipulation. Just look at the major JP Morgan silver scandal. Now, the beautiful part is this: if this leverage short hedge were to get stopped out, we still get off the hook in the green, as it would mean the remaining long positions have generated strong enough profits to outperform the individual hedge premium. For more on the technicals, please watch part 2 of the swing trade follow-up episode for September and October. That was all for now, thank you and goodbye.